Hello and welcome to the weekly wrap video. Just a couple of things to catch up on from the past 5 trading sessions. Was pretty much interrupted by Wednesday, where we did see the New Year's Day bank holidays across many of the global marketplace. So a bit of an interrupted week, but sandwiching the end of 2013 and the beginning of 2014. So retrospectively, 2013 was a fantastic year for global equity markets, with the Nikkei 225 over in Tokyo rallying at the fastest rate since 1972, alongside that market depreciation in the yen currency after New Year's Eve saw dollar yen touch 5-year highs at just below 105.50. And then over in the US, Wall Street recording its best performance for just under 20 years for the Dow Jones and the S&P 500. However, as we progressed in towards 2014, much of that sentiment being reversed as traders look to take profits on those market yearly gains, with January 2nd seeing the Dow Jones declining at its fastest rate in around 2 months, the dollar rallying firmer as investors continue to eye the recovery of the US economy and a firmer dollar on the back of potential Fed taper expectations. As we move into the first FOMC rate decision of January, we'll see a bit of a shift around of the board, potentially giving it a more of a hawkish stance. But elsewhere this week, news flow has remained pretty light, with volumes particularly light as Japan have an extended market holiday due to return on Monday the 6th of January, as they have not been at their desks for 2014 as yet. But elsewhere, given the 2-day market daily breakup, we have seen European and US traders extend the festive period holidays to the end of the week. And then to top this all off, have seen some very, very adverse weather conditions on the northeast, with up to a foot of snow landing in New York State, cutting off bridges, public transport and roads. So also volumes remaining particularly light and exacerbating price action across the asset classes. Elsewhere though, on the European side of things, as we move into yet another year of the Eurozone debt crisis, have actually seen some favourable moves in both the Italian and Spanish debt markets, with domestic banks shoring up on Spanish and Italian paper after dropping these in both November and December. So Friday's M3 money supply data from the Eurozone did show Spanish banks selling Spanish government bonds at the fastest rate in 4 years for the month of November. So some have seen this as these banks getting prepared for the asset quality review from the ECB as they look to rid their balance sheets of any potentially negative assets and shore up on cash ahead of the end of the year. And with that being out of the way and the ECB having taken this sample, they're looking to come back into the market and buy up these Italian and Spanish debt securities, bringing both their 10-year government bond yields below 4% for the first time in many years. So a quick look ahead to next week. Volumes should pick up as traders return to their desks. We also have a number of key risk events: the ECB and Bank of England rate decisions, the FOMC minutes, as well as non-farm payrolls on Friday. So in the meantime, that is all from me. I hope you had a fantastic 2013 and a great start to 2014. But have a fantastic weekend, and we'll see you again on Monday.